Chairman and CEO, Mr. Rashesh Shah, who joins us right now on the show to talk about their numbers and the outlook ahead. Rashesh, so good having you. Thanks so much for taking the time out. You would be happy with the kind of quarter that you've dished out, but break it down for us. Yesterday we had somebody coming and talking about how the bread and butter business might be doing well, but the allied businesses are now all of them at an inflection point and will only see the growth accelerate over the next 4 to 8 quarters. How has quarter 4 been for you, and how has the year been for you?
So as you saw, the fourth quarter also we have clocked 46% growth. So for the fourth quarter as well as for the year, we are at a 46% growth in profit, which is actually one of the higher profits we have achieved in the last few years. Now we have achieved a 38% CAGR in profit over 28 quarters. So we've been clocking this kind of a growth rate for now 28 quarters, which is almost about 7 years. And in these 7 years, this last year, the year that has gone by, was a very good year with 46% growth. Overall, our credit business grew, the profit in that grew at about 38%, which is more par for the course. But our franchise and advisory business, our asset management, wealth management business, had a very good growth here. In fact, our assets under advice have grown from 60,000 crores to 90,000 crores. So we had a 50% growth in assets under advice in this last 1 year, and our assets under management have grown from 19,000 crore to 28,000 crore, which is also almost about 50% growth. So very good growth in asset management, wealth management business, and our entire model has been credit business, but also very strong franchise and advisory business through asset management, wealth management, and capital markets.
Mr. Shah, congratulations on good set of numbers. In fact, the analyst we were interacting with yesterday, he sounded pretty bullish on your asset and wealth management business. Just want to get a check going forward. Do you expect more and more contribution coming in from this segment of your business?
We expect both the segments should grow. Asset management, we have 3 parts: our credit business, our asset management, wealth management, capital market, what we call franchise and advisory business, and our insurance business. We expect our credit business should clock a steady 25 to 35% growth, but the asset management, wealth management business have now hit some key inflection point and has a lot of growth because this industry is also growing. For the last about 20 years, both asset management and wealth management have grown at more than 20% CAGR for the industry as a whole. So these are high growth industries where India is getting scale, and we have invested a lot in the platform building, in the product we have, in the go-to market for our customers. We invest a lot in technology for customer experience, for customer value creation. So all of those are now coming of age, and this investment we have made were made because we knew that the market in India is very big and going to grow fairly well. I think that confidence in India has always been there, and now we are starting to see that India, at a $2.5 trillion economy, the asset management, wealth management sectors can experience 18, 20, 25% growth in the coming years.
And what's the road ahead for your insurance business, which continues to be loss-making? And if I'm not mistaken, you've already got the nod from IRDA to start general insurance business as well.
Yeah, on the life insurance business, we are in our 5th year, and we expected a break even after 8 to 9 years. So we are on track for that. Our annual premium equivalent has grown by about 40% per annum over the last few years. This year we clocked a 52% growth in that APE also. So it's a good growth here for us because the industry as a whole grew at only about 24%. So industry grew at 24, we grew at 52% in the APE in the life insurance business. We expect to break even in 22, which is as per plan, because we started this business in 13 and there was an 8-year break-even target. We might hit the embedded value break-even a year earlier, but the accounting break-even is currently scheduled for 22. On the general insurance business, we got all the approvals from IRDA. We have launched the business. It's a soft launch. We started it in Feb. And for the first year, our idea is to build out the platform, invest in technology, create some very innovative products. And it's a soft launch, and we will grow very slowly in that. But we see that also as a very big market. and all these are very synergistic adjacent businesses for us. So as they get scale, we also get value from the Edelweiss platform for all these businesses.
I was talking to a South Indian-based promoter, Mr. Shah, and he seemed more bullish on the medical insurance and the general insurance part of the business as opposed to the life insurance part of the business. I mean, those books are chalk and cheese for you right now in terms of size because you've just started off general insurance, but would that belief be true? Next 5 years out, do you believe general insurance has a higher chance of pacey and chunky growth as opposed to life insurance?
No, I think they both have almost equal kind of growth opportunity. From a year-to-year basis, based on regulation, based on environment, based on competition, the growth prospects might change on a year-to-year basis. But if we are currently planning everything in Edelweiss for a 2025 kind of a horizon. So if we look at all these businesses opportunity from now to 2025, and not just insurance, I think if you look at asset management, wealth management, retail credit, SME credit, we see from now to 2025, the market in each of them growing by 3x to 5x. So every segment in this has a good growth out there. So I wouldn't say whether life insurance is better than general or general is better than life. I think they are both good. They have obviously different kind of products, but the value creation opportunity exists in both of them.
Credit book, which is already fairly large, Mr. Shah, you expect that to have a 3x to a 5x growth in the next 6 years?
If you see, credit in India has been actually doubling in size every 4 years for the last 20 years. So the current credit will also double again from the current outstanding credit by 2022. We'll see a doubling of credit and maybe another double from 2022 to 2025. So 4x growth in the credit outstanding as a whole. The entire system credit in India is today 100 trillion rupees. And we think somewhere between 350 to 400 trillion rupees should be the credit outstanding for Indian economy as a whole. Out of this, retail might grow faster. We think the corporate credit will grow at about 2.5 to 3x, and retail might grow at 4 to 4.5x in the coming 7 years to 2025. So, and it is happening. All the retail credit, whether SME, mortgages, the market is growing at 18 to 20% per annum, which itself makes sure you will double in 4 years.
Mr. Shah, you guys have been quite bullish on the distressed asset play. Tell us, how was the performance of the ARC business this time around? What's been the contribution of that on the bottom line? And also, if you could throw some light on the kind of haircuts that you've been taking in acquiring some distressed assets.
So on the ARC business, last year our profit after tax was approximately 100 crores. This year it has gone to 180 crores. So we have had a good growth on that. But as you know, we own only 60% of the ARC business. So out of 180 crores, only about 114, 15 comes to our bottom line. So if our current tax insurance bottom line is 1036 crores, 1036 crores, about 12 to 13% of that comes from ARC business. So we are fairly well diversified. Our wholesale credit contributes to about 20-22% of our profits. Our retail contributes to about 15-18% of the profit. ARC is another 12. Asset management, wealth management is another 18-20% of our profits. Capital market is another 14-15%. Treasury is another 10%. So we are fairly well diversified in terms of the business lines we have. And on ARC, we are seeing good growth opportunity. We've been growing our book at about 20-25% per annum. We are the leaders in the industry. We expect that growth will continue because more and more banks are coming forward to sell assets. Of course, pricing is always an issue. Historically, we bought most of the assets at about 42 to 45 cents to a dollar, and we hope to continue with that. Our focus has been on good quality assets, where the underlying asset quality is very good, the plant and machinery is operational. A lot of these are operating companies with either weak management or broken balance sheets. And our expertise has been in aggregating the debt, fixing the broken balance sheet, working with the management or bringing in new management and reviving the companies. In a lot of companies where we have taken over the debt, We have increased capacity utilization from 30% to 80%, from EBITDA from 10 crores to 100 crores. So that are the opportunities we are looking for. We think there are a lot of such opportunities where we can add value in helping clean up the balance sheet, strengthen the balance sheet, improve the operations and scale up the cash flow and profitability of these companies, which are good quality companies but broken balance sheets or very weak promoters.
Mr. Shah, I remember in one of the previous conversation, the management had highlighted last year that you guys were paying nearly 60 to 70 cents to a dollar when it came to acquiring assets. So that number seems to have fallen, as you mentioned, between 40 to 45. So that's a good news. Before we let you go, just last question from my end. I don't know if it's the right platform to ask or not. It's an earnings interaction. Would you look to unlock any of the businesses which are doing well?
Not as of now. And our whole idea has been that we are open to strategic partnerships. We've been approached by a lot of strategic partners. So when we got the Canadian pension fund CDPQ came and bought 20% in our ARC business, we did that very happily. We have a partner in our insurance business. Tokio Marine owns 49% of our life insurance business. Even that we are happy with. So we are more inclined towards strategic partnerships or partners who can add long-term value with us in building the business, in creating value for that. For doing it as a financial engineering, we have not been very keen on that. And as you know, we just raised QIP in the last quarter. So from a capital point of view, we have enough growth capital with us. And if we can maintain this growth and this profitability, we think we'll also generate enough internal earnings not to have to sell stakes either at the holding company or at the subsidiary level in a hurry. But for the right partner, for the right opportunity, for the right kind of growth that we can see, we are always open to opportunities, but we don't have any plans for that.
We'll leave it at that, Mr. Shah. Thank you so much for taking the time out and congratulations on a very healthy quarter.
Thank you.